Welcome back to the channel. If you've been struggling to find high-probability trade entries, you're likely looking at the wrong things. Most traders rely on basic support and resistance lines, but the big players, the institutions and banks, operate differently. They move the market through demand and supply zones. In today's video, we are going to strip away the noise. I'm going to show you exactly how to identify these powerful zones, why they work, and how you can use them to catch massive market moves. Let's dive in. What are demand and supply zones? First, let's define what we are looking at. At its core, the market is a battle between buyers and sellers. A demand zone is a specific price area where a massive influx of buy orders has occurred. This creates a sharp move upward, leaving behind unfilled orders. When price eventually returns to this area, those leftover orders get triggered, usually leading to another bounce. A supply zone is the exact opposite. It's an area where big players sold heavily, causing the price to drop aggressively. These zones act as a ceiling. When price climbs back up to a supply zone, the remaining sell orders push the price back down. Think of these zones as the footprints of the smart money. How to identify the zones? The leg in and leg out. Identifying these zones is easier than you think. You are looking for a specific structure. Every valid zone has three parts. The leg in. This is the initial move into a base. The base. This is a small cluster of candles where the market pauses or consolidates. This is where the orders are being collected. The leg out. This is the most important part. You want to see a strong, explosive candle, usually a large Marubozu or an engulfing candle, leaving the base. The more violent the leg out is, the stronger the zone. If the price slowly drifts away, the zone is weak. But if it teleports away from the base, you've found a high-interest area for big institutions. Trading strategy. The return to base. Now, how do we actually trade this? We don't chase the price when it's exploding. Instead, we wait for the market to come to us. This is called the return to base. Once you've marked your zone using the base candles, you wait. When the price retraces back into that demand or supply zone, look for a rejection. For a demand zone, you want to see a bullish reversal candle once price enters the box. Set your stop loss just below the zone and target the next major supply area. For a supply zone, wait for the price to climb back into your box, look for a bearish signal, and set your stop loss just above the zone. The beauty of this strategy is the risk-to-reward ratio. Because your zone is often small compared to the resulting move, you can easily achieve 1 to 3 or even 1 to 5 trades. Pro tips and conclusion. Before you go, keep this golden rule in mind. Freshness matters. The first time the price returns to a zone, it is at its strongest. Every time the price hits that zone again, it consumes more of those unfilled orders, making the zone weaker. Always prioritize fresh zones. Trading with demand and supply is about patience. It's about waiting for the market to return to where the big money is waiting. If you found this breakdown helpful, hit that like button and subscribe for more institutional trading insights. Leave a comment below if you want a deep dive into any specific part of this strategy. Thanks for watching, and I'll see you in the next one.